Hey everyone, welcome to today's video on my channel. And today in this video, we are going to take a look at an intraday strategy which is suitable for the current market condition. So if you actually look at it, option sellers are having pretty tough time in 2023 where selling is not really working out because of low premiums and also irregular market movements. So there is random spikes which are coming in and taking stop losses. So we are going to discuss a framework based on which how you can build your selling strategies, and every single thing which we are going to discuss today is going to be data driven. So we are simply not going to suggest a strategy, but we are going to take a look at the past 1 year data, see how the market has behaved, and based on that we are going to build our strategy. So I'm pretty sure that you are going to find this video very informative. Make sure you stick till the end, before which you can also hit the like button, share this video and subscribe to my channel. Now let's quickly start off by looking at the data and trying to identify the broader problems in the market. So whenever we want to build a strategy, it is very important for us to understand how exactly the market is behaving or what is the dynamics of the market, based on which we can build the strategy. So first, let's take a look at the data points. Here what I have done is taken the 15-minute data of Nifty from the last 1 year, that is November 2022, and I have done a detailed analysis of the data. So if you look at it right over here, we have 6,586 data points, that is 15-minute bars. So we have totally 6,586. And what we also know along with this is the average straddle premium over the last 1 year on the expiry day. So if you actually go on an expiry day 9:30 a.m., the average straddle premium has been around 75. So this will help us understand why exactly it is becoming so hard to sell options in 2023. So if we actually take a look at it, the average premium on an expiry day is actually 75. But if we take a look at how many times the market has moved more than 75 points in 15 minutes, you look at it. So there is a 2% chance the markets can actually move more than 75 points in just 15 minutes. Now, if you take a look at 1 hour, so if you actually look at it, there is a 20%, or to be precise, 17.56% chance that the markets can move more than 75 points in just 1 hour. So now if you take a look at it, you know for overall day or the entire day, you have a premium of 75 points, but the market is moving more than 75 points 20% of the times just in matter of 1 hour. Now, if we extend the range from 1 hour, let's say we look at 3 hours, right? So overall premium we have for the day is 75, but 51% of the times the market is actually moving more than 75 points within a span of 3 hours. That means from 9:15 to 12:15, there is a 50% chance the market would have moved more than 75 points. Now, if you actually look at the entire day, right? So that is from the beginning of the day to end of the day, there is a 95% chance that the market range is going to be wider than 75 points. When I say wider than 75 points, so I'm talking about the range between high and low. So I'm not talking about the range between open and close. I'm talking about the high and low. So assuming that you are starting at the low of the day, so there is a 95% chance that the market would have already moved more than 75 points during the day. So this is one analysis what we have done based on the data available. And now this clearly shows why selling has become so hard. So let's say I create a short straddle in the morning and the market is moving so violently that the option premiums are randomly surging and hitting my stop losses. So let's say if I create a simple short straddle and keep a stop loss, most likely the stop loss is actually going to get triggered. So when you actually take a look at the past 1 year data only on an expiry day, so there's approximately 52 expiries, out of which 40 expiries the stop losses have been taken out. Why this is the case? So this is keeping us low stop loss. Why this is the case? We are seeing random spikes. So today when we are building a Nifty system, what we are going to do is first we are trying to address the problems which are existing and see how we can find a solution to that. Based on that, we are going to build a system and completely automate it. So we are going to automate with the software called as finarget. I'm going to show you how you can automate the entire system for free. And the system what we are going to build is also going to have a fantastic expectancy. So this is just a framework. You can modify things and build better systems based on this. And everything is again going to be data driven and nothing is going to be out of the random. First, let's try to start addressing the problem and see how we can start building better systems. Now I'll be moving on to the screen recording, and I also hope that this video is going to bring a lot of value to you. In that case, don't forget to hit the like button, share this video and subscribe to my channel right away. And also, if you open a Firstock account using the link in the description below, so you will be getting first 100 orders free. You can also automate your strategies using finarget for lifetime absolutely for free. There are more than 1 lakh plus orders which are placed using Firstock accounts on finarget. So what's stopping you? So quickly click on the link below and open your free Firstock account now. Hi guys. So broadly, if we take a look at the entire market scenario, we can identify 3 problem statements. The first one is spikes and gamma moves. So an option which is trading at 10 rupees is suddenly spiking up to 18 rupees, 20 rupees. And a gamma move is something like where a 2 rupee option suddenly shoots up to 15, 20 rupees. So these two are some scenarios which we are getting to see quite often in this market. And this is the first problem statement what we have. The second problem statement what we have is when it comes to selling, the VIX is very low, because of which the option premiums are quite low. So this is something which we already discussed. So we are not able to go far OTM. So to collect higher premiums, we are forced to come closer in. But once we come closer in, the market is moving violently and hitting our stop loss. And finally, we also observed how the market is moving, and the probability for an option seller to make money has significantly reduced. So if I am selling ATM options, the range of the market is quite high, and very easily the market is breaching the range within matter of few hours itself. So these 3 are the main problem statements when we try to build a system. And once we build a system, we would be actually trying to address these things while we build it. So in our hands, we have quite a lot of problems to be solved, right? So it cannot happen just that we go far OTM. Then if we go far OTM, the gamma move is going to be an issue. If we come closer to ATM, then we are going to have issues of lower probability of making a profit. So how can we try to address everything in a way it is going to fit the current environment? So right now, I will suggest a framework which is actually going to help us fight all these problems together, right? So the first framework what I would be suggesting is to go for a OTM call option and OTM put option. So we would be selling OTM options and creating short strangles rather than creating short straddles. So this way we can actually try to increase our probability. So we'll come one by one. So one way to increase our probability is to actually go for far OTM options than ATM options. The second thing what we can do to increase our probability is not to trade on all the days, right? So as an option seller, all of us know for a fact that so the highest probability is usually when we are closer to expiry. So 0 days to expiry, 1 day to expiry or 2 days to expiry is the time when a seller can make the highest profit by selling options. So rather than trading on all the days, let's try to stick to trading on 2 days to expiry, 1 day to expiry and 0 days to expiry. So in case of Nifty, it would be on Tuesday, Wednesday and Thursday. So we have actually tried to address the third problem in 2 ways. One by going far OTM, and second one also trying to focus on the days when we have higher chance of making profit. That is 2 days to expiry, 1 day to expiry and 0 days to expiry, which is Tuesday, Wednesday and Thursday, right? So now this is actually going to cause one more issue, and that is the second issue. So the second issue is basically when we go far OTM, right, the VIX is very low and the premiums what we get is also going to reduce quite a lot. If the premiums are going to be low, even our return is going to drop to a great extent. So we can't go so far OTM that our returns are going to come down quite a lot. Neither we can come closer to ATM such that our risk increases. So we have to try to find the sweet spot. So in my opinion, the sweet spot is somewhere between 15 to 20 rupee option in Nifty. But for this framework, let's just stick to a 15 rupee option. So let's not try to go for a 20 rupee option. So we'll try to keep our risk low by going for a 15 rupee option. So once we have gone to 15 rupee option, so we are now far OTM. The next issue is going to be of spikes and gamma moves. So if we can find a good way to address this issue, then More or less, we have built a fantastic framework through which we can start improvising our system. So right over here, we are only focusing on trading Nifty. So that's why I have chosen 15 rupee option. So it is very hard to define in terms of ATM reference. So I can't tell go ATM plus 50 points, ATM plus 100 points. It is very hard to define in terms of ATM reference. So that's why we'll be using something called as closest to premium of 15 points. So once that is done, we have the issue of the gamma move. Let us say the market simply starts to spike and there is a sudden 50-100 point jump and market suddenly shoots up. Then that is going to cause a huge issue, because of which we have to make sure that our overall stop loss, whatever we are keeping for a leg, is lesser than the total premium collected. Let's say in this case, I keep a stop loss of 7 rupees. 7 rupees for the calls and 7 rupees for the puts. So what exactly ends up happening is, if there is a sudden surge in call option, so I am just going to lose 7 rupees from the call side and I can make 15 rupees from the put side. And if there is sudden fall in Nifty, then my put stop loss is going to get triggered, where I am going to lose 7 rupees and I am going to make 15 rupees from the call side. So you can see what exactly is happening here. We have more credits, because of which even if one side hits the stop loss and other side goes to 0, so we are still going to make money. And even if there is a V-shaped move, since we are trading OTM, our risk is much lesser. So even if the market falls completely and comes back up, our OTM option might not trigger the stop loss at all. So if we are trading ATM, there's a higher chance our stop loss is going to get triggered with a V-shaped move. But by trading OTMs, we are reducing that risk. And finally, the issue is with the spike. So now we have addressed the low probability. Now we have addressed the low premiums. And we have also addressed the gamma moves. Finally, how do you avoid spikes? That is by using a trailing stop loss. Assuming that the market starts to move in your direction or in your favor, right? So you can simply start to trail your stop loss, such that in case if there is a spike after options losing the premium, let's say this 15 rupee option comes down all the way to 6 rupees or 3 rupees, right? So now the chance is that, what if this 3 rupee option goes to become 30 rupees? Or what if this 3 rupee option goes and hits your stop loss, right? So you can completely avoid that by simply trailing your stop loss. And this is going to avoid all kinds of spike issues. So what we are going to do is, for every 1 point dip in the option, we are going to trail the stop loss by 1 point. Just to give you an example, let's say I have shorted this at 15 rupees. Stop loss is going to be at 22 rupees. So 7 points higher. So whenever this becomes 14 rupees, I am going to change the stop loss to 21 rupees. Whenever this becomes 13 rupees, stop loss is 20 rupees. If this becomes 10 rupees, stop loss is going to be 17 rupees. So for every 1 point dip in the option, we are going to trail our stop loss by 1 point. Similarly, we are going to do the same thing for OTM-PE. So what we have essentially done here is try to address one by one problem. So the low probability of making profit is addressed by going far OTM and trading only on Tuesday, Wednesday and Thursday in Nifty. And this is also going to avoid any kind of V-shaped move. So the probability of getting hit by a V-shaped move is avoided both by staying far OTM and doing trailing stop loss. The second issue what we had is going for low wicks and low premiums. That's why we decided, rather than going with ATM plus 100 or ATM plus 200, we'll stick with options trading around 15 rupees. So 15 rupees is not a very bad premium for Nifty. The third issue what we had was of gamma moves. What if the market suddenly trends? So we are going to get a hit with our options. So what we did is, we kept a stop loss such that even if one hits the stop loss, the other can go down to 0. And finally, to avoid spikes or reduce our loss from spikes, we started to keep a trailing stop loss. If the market moves in our direction, our stop loss would have already been reduced, and that's the reason our loss is going to get reduced. Now coming to the final part of execution. So what we are going to do is that there is a higher probability of market behaving violently in the first hour. So we are just going to avoid the entire first hour, and we are going to take our entry post 10:30. So let's take our first entry at 10:39. So we are going to have 2 entries so that our entire system is going to be diversified. Rather than having 1 entry, let's try to focus on having 2 entries. The first entry is going to be at 10:39 and the second entry is going to be at 11:39 so that it can complement the first entry. So it can act as a good complement to the first entry. In case if the market has moved higher, so then we can simply end up creating one more strategy over there. So we are going to stick to a simple system where we have a simple closest to premium entry, stop loss, trailing stop loss, 2 entries. So one coming at 10:39 and one more at 11:39. So once this is done, now it's time to backtest. So one more thing very important to understand, this is not a recommendation. I am just telling you how to create a good framework. So please make sure that you follow the steps. So right now, what we have done is basically listed down the problems and try to address them one by one rather than simply creating a system. And the environment of the market can change tomorrow. This particular strategy might not work going forward. So this will be only working in a low VIX environment when there is a lot of spikes and gamma moves. Some other strategy might work better some other time. So please make sure that you are also dynamic in changing your strategy along with the market. So don't stick to the same strategy even when the VIX is high. So try to make sure that you analyze the market dynamics and build your own strategy. So right over here, I have come to fintarget.in, where I can simply automate my strategies. First, I am going to show you how you can build this strategy on FinTarget. The same thing can be used to build on any other backtesting platform. And then I'm going to backtest and show how exactly the results are. So once you have come to fintarget.in, you can sign up in case if you haven't, or you can log in case if you have already signed up. So once you have logged into the platform, you can simply click on create new. So here I'm going to name this as Nifty 1039 strategy, right? So the starting time would be 10:39. So I'm going to set that, and the ending time would be 3:29. So whatever is the last time. So it will automatically take the last time. So I'm going to sell a Nifty option. I'm going to change this to closest to premium, and I'm going to put 15 rupees, right? So I'm going to sell a 15 rupee call, and I'm going to sell a 15 rupee put option. So here I am going to change the number of lots to 10, and I am going to place a stop loss. So the stop loss is 7 points for both calls and puts, and I am also going to place a trailing stop loss of 1:1. So it's already by default points. So the X and Y here would be 1 and 1, and even the X and Y here would be 1 and 1. So now I have to select the days to execute. We already decided we are going to execute it on Tuesday, Wednesday and Thursday. That is 2 days to expiry, 1 day to expiry and 0 days to expiry. So I'll just save this strategy. So what I'm going to do is simply click on duplicate, and I am going to change this strategy name to 11:39. So nothing changes, the same parameters. Only thing, the time of entry changes. So you can see that I have created my second strategy in matter of less than a minute. So in case if you are going to use FinTarget, you don't even have to sit and automate, because what I'm going to do now is create a link and share this strategy with you. So I'll be copying this link and I'll be pasting this link in the description below. So I'll have both the links pasted as strategy 1 and strategy 2. You can simply click on this and the entire strategy will be created. You can save it and start executing. You're going to save so much time without having to sit and enter all the specifics. So the entire thing is created. Just click on the link and save it in your FinTarget account right now. So all I have to do next is add a broker. So I'm just going to click on setup in Firstock, and I'm going to log into my account. So right over here, you can see that we have special offers running with Firstock. You can use FinTarget absolutely for free, any number of strategies. So unlimited strategies absolutely for free by having a Firstock account. So in case if you don't have one, you can simply click on the link in the description below, or you can also go to offers in the tab section and open an account and get 2000 rupees worth brokerage credits absolutely free. So once you have logged into your broker, on the specific day, you can simply click on run. So now, since we know how you can set up the strategy, the same setup can be used even on Stockmock to backtest. So I have already done that right over here. I have set up the first strategy, which is S1, which is happening at 10:39. So we can see the specifics when I open the strategy. So it is Nifty call sell, which is trading around 15 closest to premium. Nifty put sell, trading around 15 closest to premium. 7-point SL and 1:1 trailing stop loss, right? So what I'm going to do here is I'm going to backtest only for the last 1 year. Why exactly I'm backtesting for 1 year is because if I backtest from 2017 or 2019, all option selling strategies have done really well. So it makes no sense for me to show you that from 2017 this strategy is doing well, right? So every single thing would have performed well from 2017 because the market was like that. So the real test for any strategy is in case if it has given good returns in the past 1 year. So even if you're doing any kind of backtest, make sure you don't select 5 years or 3 years because the results is going to be biased. Only select for the last 1 year or 6 months and then see how the strategy has performed. And also one more really important thing is that we also have a Stockmock link attached in the description where you can do more backtest like this. So by signing up using that link, you will also be getting 20 paid credits. So you can use to backtest the strategy for 20 years worth of data. So now I'm going to run all the strategies, and once we have the results, so I have changed the days of execution to 2 days to expiry, 1 day to expiry and 0 DTE. So as I come down, you can see right over here, on an average, this strategy is giving us a return of close to around 24%, right? It has a winning probability of closer to around 78% or 80% winning probability, 24% returns with a drawdown of just around 0.3%. So you can look at it. This is a fantastic strategy which has an expectancy of over 1.5 and return to max drawdown of 66 or 67. You can also see there was drawdown for only 18 days and this entire drawdown was recovered just in 6 days. So just look at the statistics of this strategy. This is fantastic. An expectancy of anything over say 0.6, 0.7 is considered to be fantastic, and a return to MDD of over 10 is considered to be like a gold mine. Right now you have a strategy where expectancy is 1.5 and the return to max drawdown is close to around 70. You have 80% chance of making a profit. Your average risk to reward is more than 1:2, and past year you have made an overall profit of 24% with a maximum drawdown of just around 0.3%. So you can see that this strategy has been profitable almost every single month, where you have got return of close to around 2% on an average. This is considering 0.5% slippage. So please make sure that the slippage is already considered. And when you look at the individual days, right, just look at how consistent your profitability has been. So many green days, hardly 1 or 2 red days. When we further expand into it and see your cumulative profit, just look at this equity curve. Consistently it has gone up. So all the way from 0 to 50,000 consistently it has gone up. And to create this strategy, you need a margin requirement of closer to around 2.5 lakh, where on an average you can earn close to around 2% a month, right? So this entire thing can be automated for free using finarget. So you can come and see further specifics of the strategy in Stockmock. So you can see every single day what was the profit or loss you made using this strategy. So in my opinion, this has worked out really well. So in the last 1 year, because this was a strategy built based on the issues. So you identified the issues, you also try to address the issue by building a fantastic strategy. So this is just a framework. I'm pretty sure you guys can work on this framework and make much better strategies. So once you build a better strategy, do share your expectancy and your return to MDD in the comments below. So you don't have to share your strategy. Just tell me what was the maximum you were able to achieve using this simple framework. So I hope this video brought some value to you. So this is more of a simple nifty system where you can totally automate it. So this is a low risk, low return system. You can see that the returns are not very high, but the risk is even lesser, just 0.3% is the maximum drawdown. And meanwhile, if you have found this video informative, don't forget to like the video, share this video and hit on the subscribe button right away.